I'm DMcGraw, and this is the ROIC margin investment strategy, how to find untapped value in the marketplace. This is Finance 695, July 2013. So what is ROIC margin? Well, simply put, ROIC is return on invested capital, and the equation ROIC minus WACC, or weighted average cost of capital, is what I've dubbed the ROIC margin. Essentially what your return on invested capital is whenever you spend money on a capital project, you want a return for your shareholders, for your lenders, for everybody. You need a return. You need to create value out of that money spent on projects. So that's what your return on invested capital is. Now, the money you have isn't just cash. You borrow money from lenders, and also you take money from shareholders. Now, those lenders require interest, and your shareholders also want to make money off the money they invest in you. So that is your weighted average cost of capital. It is the amount of interest you end up having to pay your lenders and your shareholders whenever you take their money. So margin, ROIC minus weighted average cost of capital, and that gives you an idea of the efficiency of your company, how you spend your money. So why not use economic value added? The definition of economic value added is the net operating profit after taxes multiplied by the ROIC margin. The problem with that is you can have a very, very large company with a small ROIC margin, and their economic value added can be very, very large. I don't feel like that is a good way to evaluate companies, especially when you have large companies, you have small companies. So I'm taking out that net operating profit after taxes, and I'm just focusing on a company's ability to take what their lenders and their shareholders are giving them and to create value, to get a return on that invested capital. So we don't want it to weigh on larger firms, like I said, economic value added, and I feel like this margin really does level the playing field. So what's the theory? The ROIC margin is a measure of your financial strength and efficiency. Like I said, how you spend your money, how well you spend your money, and if you can unlock and create value whenever you are investing in capital expenditures or any projects like that. You need to execute these projects to increase your shareholder value. You know that you're going to pay your lenders first. What's left is your shareholders. You want to create value. You want to make money for them. And I feel like this is much more important than, say, like a profit margin metric, because some companies make all their money on asset turnover. Their profit margin on their products may be small, or profit margin on their revenues may be small, but their asset turnover is really what drives their return, or their ROE and ROA. So the year-over-year ROIC margin can tell a story, and essentially if it's large, you know the company's doing great. Is it small? Is there an issue? Is it increasing? Is it decreasing? Obviously an increasing ROIC margin would be beneficial. A decreasing is something to be concerned about. And the big thing I show here is whether you're a $1 million company or you're a $100 billion company. It absolutely doesn't matter. You can be small, and your ROIC margin can tell you whether you are doing well and creating value with your projects. So testing the theory, how do we do it? Well, we took the 22 companies that the class chose, the employers of the students, the competitors of those employers, and South Louisiana companies. So this is the same test group we used for the stock portfolio project as well. And I determined that this sample group was diverse enough, as opposed to choosing a whole separate sample group. I felt like this group was across multiple industries, large companies, small companies. I felt it was a really good way to figure out if this investment strategy would be a good one. And I used 2010 through 2012 financials. Essentially, I took the 3-year average ROIC margin from 2010 to 2012, and the average percent change in stock price over 3 years. So how do we test this? Well, we're going to use a regression analysis. I plotted stock price against ROIC margin, and we're going to see if ROIC margin and stock price have a positive correlation, noted by this question mark in this graph here. So not only are we going to do a visual by looking at the trend, but we're going to do statistical analysis, and we're going to see if this is statistically significant based on the p-value. So we're going to look at the trend and see how good the fit is as well. So proof in the pudding. As you see here, ROIC margin is on the x-axis. The annual percent change in stock price is on the y-axis. What you're seeing here is there's a positive relationship. The R squared value is about 27 or 28%, which really isn't bad for this grouping, I believe. An R squared value of 1 would be a perfect relationship. Every dot would be on that regression line. To give a little background, so it's a very decent R squared for this sample set, I feel. The p-value proves that this is statistically significant at 0.0119. Anything less than 0.05 we consider to be statistically significant, so that's a positive. But what we do see here is this one single outlier, and I really felt that this is a 22 company set, and that outlier doesn't really represent a normal company. I feel like you always do have outliers in data sets, and so I actually decided to take that data point out and see what my regression would look like then. Because many things can happen with companies, many reasons. There can be many reasons why somebody's stock price increases, although they're not creating value with their projects. So, took that one away, and as you can see here, the regression equation in the R squared value changed. It went from 27% to 44%, which is a very, very positive increase. The fit dramatically improves, and I want to stress that I took away one data point out of 22, which is less than 5% of the sample set. So I felt like this is a more meaningful representation, and I feel like the majority of companies, if you were to add all of them together or choose a different sample set, would look something like this with a relatively good R squared. So what's the p-value here? It's even better, 0.0004, so very statistically significant. So what's the summary? The ROIC margin is a very strong investment strategy. I feel like it shows the financial strength of a firm, regardless of the company's size. It also demonstrates the capability, the innovative nature, and really how efficient a firm is with their capital expenditures. You have to be able to create value with your projects. It's already understood, I feel like it's generally understood that a positive ROIC margin is what everybody wants. If you have a negative ROIC margin, you're not creating any economic value and your firm is headed south. But really, that qualitative understanding that it's positive for a firm, what does it mean for stock price? I feel like that the statistical analysis does prove that there's a definite relationship with stock value and ROIC margin. And that's all I got, so appreciate it.